requirements for the VA. Like I said, it's very black and white now. You're under the asset limit, you're using your income for care, then you qualify for VA benefits. The only kind of difference is we can still protect the house because it's an exempt asset. But other than that, any liquid assets, we can't do anything anymore to protect them. So, that's the VA side of it. But what if you're not a veteran? What if you don't have access to VA benefits? The only other benefit that's available in the state of California is Medi-Cal. And Medi-Cal, just like the VA, has two different sides to it. The side that most of us are familiar with is the community-based Medi-Cal, health insurance for people that are low income, right? When you think Medi-Cal, you think, I have to be poor to be on Medi-Cal. I get that all the time. People come in my office and they say, I have too much money or I make too much money, I'm not eligible for Medi-Cal. And that is true for community-based Medi-Cal because the income and asset limits for community-based Medi-Cal are really low. So for community-based Medi-Cal, for a single person, they can't have more than $2,000 in the bank. For a married couple, they can't have more than $3,000 in the bank. Income-wise, in order to qualify for community-based Medi-Cal, a single person can have a little over $1,200 a month, and a married couple can have about a little over $1,600 a month. That's not a lot of money. And so you do have to be low income, low asset to qualify for community-based Medi-Cal. And if you qualify, basically what it does is it pays for your health insurance. There's lots of different programs in community Medi-Cal. There's programs for the aged, there's programs for the blind, there's programs for kids, there's programs for people who are on dialysis. There's lots of different programs under the community-based Medi-Cal, but you have to meet those requirements. The income can't exceed $1,200 or $1,600, and the assets can't exceed $2,000 or $3,000. On the other side of that is the long-term care Medi-Cal program. And that is a program that is specifically for middle-class families, because even a middle-class family cannot afford to pay $8,500 a month for a nursing home. So the long-term care program, the requirements are a lot higher, the income requirements and asset requirements. So I gave you this handout that says long-term care Medi-Cal. Very first thing on there, your house. Your house is an exempt asset for Medi-Cal as well. Whether it's a $200,000 condo in Chino or it's a $2 million house in Newport Beach, it doesn't matter. Your house is an exempt asset for Medi-Cal. I did an application for a lady a couple of years ago. She had a house in Rancho Palos Verdes. It was a $2.5 million house, completely exempt for Medi-Cal. We were able to put it into a trust and protect it so she can be eligible for Medi-Cal. She had this beautiful house, but she had no money. And she had no cash. Everything, all her only asset was this house that she had inherited from her parents. So your house is exempt. You may have other real property if it's used as a means of self-support, and I'll talk about that a little later. All of your household goods are exempt for Medi-Cal, so your furniture, your dishes, your jewelry, anything that's in your house is exempt for Medi-Cal as well. Your jewelry, there's very specific language in the code about jewelry, and it says your wedding and engagement rings are exempt, and heirloom jewelry is exempt, but anything other than those things that have a fair market value of $100 or more, technically you're supposed to list them on your application. Medi-Cal does not go through your house looking for jewelry, so I never list personal items on an application because you can give it to your kids and there's no issue with that. And I always tell people, if you have jewelry that you want to give to somebody, give it to them now. Because when you get sick or you die, those things tend to disappear. So give it to whoever you want to give it to while you're alive. Your vehicle is exempt for Medi-Cal. One vehicle, whether you're a single person or a married couple, one vehicle is going to be exempt. And again, regardless of value. I did a Medi-Cal application a few years ago, and it was a couple that had retired, and they bought this giant motorhome. They spent $500,000 on a motorhome, which is, when I say it, it's still shocking to me that a motorhome costs that much money. But they had these pop-up TVs and surround sound, and I mean, it was this beautiful motorhome. Wife got sick, she had to go into a nursing home, they had to apply for Medi-Cal, and he said, I can't get rid of my motorhome. And I said, okay, fine, we'll list it as your one vehicle. So we listed his motorhome as his one vehicle. So again, regardless of value. Yes?
Remember I asked you yesterday or the day before if a sailboat would qualify?
As a residence,
as a
it
resident?
does not qualify.
Did you call?
I looked it up.
You looked it up?
Yeah.
I called.
Yeah, it doesn't,
Yeah.
it doesn't qualify.
Why not? I live there. That's my primary residence.
Because it's personal property, you can move it.
Okay,
You called them too?
I called them.
Yeah, it doesn't qualify, but it's really easy to protect a sailboat, and I'll tell you, I'll talk about that.
Okay.
Yeah. Okay, whole life insurance policies. Whole life insurance policies may be exempt if the cash value is $1,500 or less. So do you all know the difference between a cash value and a death benefit on a life insurance policy? The death benefit is, how much money will my family get when I die? That's the death benefit. The cash value is, how much can I borrow from my policy while I'm alive? So when you have a whole life policy, you're making your premiums every month, right? You're paying that premium monthly or annually or whatever the case may be, and you're starting to build up some value in that policy that you can borrow from. And so if that cash value, the amount that you can draw, exceeds $1,500, then the policy is not exempt. But if it's less than $1,500, then the policy is exempt. Term life insurance policies are exempt because term life has no cash value. So term life policy is a policy that you get for a certain period of time. So you can get a 10-year term, you can get a 20-year term. When I bought my house, I had a 30-year mortgage, so I bought a 30-year term policy. So if I die before my mortgage is paid off, I want my daughter to be able to get some money to pay off that mortgage. So you can choose the terms that you want with the policy, but they don't have any cash value because you're not building any equity in those policies. Your burial plot is exempt for Medi-Cal. So if you've gone to the Rose Hills and you paid for your plot already, that's exempt. Your burial plan, so sometimes people pay for their entire funeral plan. They buy the casket and the flowers and they pay for everything ahead of time. That is exempt if you make it irrevocable. And it's really easy to do that. You go to the mortuary, you say, hey, I need to make this irrevocable. They say, okay, sign this piece of paper, and it's done. They know how to do that because they do that all the time. And so Medi-Cal is really, if you notice what I'm saying, is that they're making sure that you can't take money, there's nowhere that you can get money from. If you can take the money, they're saying take it and pay for your care. So anything that's irrevocable, anything that is cashable, they want you, or revocable or cashable, they want you to take that out.
So you have to charge this as a asset? For example, the term insurance is excluded, but some company, by ethical funding, they can pay your policy and then
If you do that, then you have to report it. Yeah.
if not.
If not, then it's excluded. So he's asking about, let's say you have a term policy, and there are companies out there that will buy your life insurance policies from you. If you sell your policy and now you have cash, it's no longer excluded. The cash is not excluded. So if you sell the policy, then it becomes an available asset for
So
Medi-Cal.
if it's excluded, you don't have to include it.
If it's excluded, you still have to report it. You still have to list it, but they're not going to count it against you. So when you submit an application for Medi-Cal, they're going to ask you, we want to know everything you own. Do you have annuities? Do you have life insurance? And if you have life insurance, we want to see statements and we want to see what's the cash value. If it's term, we want proof that it's term. So they want to know everything you have. So next thing, we talked about the burial plans. If they're irrevocable, they're going to be completely excluded from Medi-Cal. Now, big difference between VA and Medi-Cal is I told you VA counts all of your assets, including retirement accounts. Medi-Cal excludes your retirement accounts. So if you have a 401k or you have an IRA, they are not countable assets for Medi-Cal. I just did a Medi-Cal application earlier this year. I had a single gentleman. He didn't have a whole lot of money. He was under the $2,000 limit, but he had $250,000 in an IRA. And he was eligible for Medi-Cal because the IRA is an exempt asset. However, when you have an IRA, you have to take distributions when you reach a certain age, right? At 70 and a half, the IRS requires you to take distributions, and there's a formula that figures out what the required minimum distribution is. So that distribution that he takes every year, it counts as income. But the $250,000 that's sitting in the account does not count as an asset. So I always tell people, if we're going to apply qualify for Medi-Cal, you need to make sure that your distributions go down to the bare minimum, because if you're taking more than the minimum, you're just gonna have to give it to the nursing home as a share of cost. So it's gonna count as income. So any retirement accounts that you have, 401ks, 403bs, IRA, anything that is a tax-deferred retirement account is gonna be exempt. Now, for a single person, they still have the same asset limits, $2,000, that's it. You can't have more than $2,000 in the bank if you're a single person. If you're a married couple and only one person is going into the nursing home, the person in the nursing home can only have $2,000. The person at home can have up to $126,420. That's a big difference between Community Medi-Cal, $3,000, $126,000. And like I said, this program is specifically designed for middle-class families. We don't want the spouse at home to have to use up all of the assets to take care of the spouse that's in the nursing home, and then there's nothing left for that person. So they're going to be allowed to keep that $126,420. Now, the income for did you have a question?
Yes. The 2,000 cash reserve in the bank, can they put somebody on that as well?
You can put somebody on the account, but you can't put somebody on the account and then say they own half of it. So Medi-Cal says if you're adding a joint account holder, we want to see that that joint account holder has contributed to the money, to the account. Yeah. Yeah, and legally, the rules don't say that, but that's what Medi-Cal does. The rules have nothing about that, but Medi-Cal eligibility workers have taken it upon themselves to do that. So, and remind me if I forget, somebody up here remind me to talk about Medi-Cal eligibility workers when we're done. Okay, then they're gonna look at the income. The income for a single person, let's say on the back side of this I gave you some examples. Let's say that I have a single person, goes into a nursing home, he has $1,300 a month income. Let's say it's his Social Security. Medi-Cal says you're allowed to keep $35 a month. You're in a nursing home, we're paying for everything. We don't think you need more than $35 a month for your incidental. So if I have a single person with $1,300 a month income, they get to keep $35, and then they pay the nursing home the additional $1,265. That's what's called their share of cost. So $1,300 a month, I get to keep $35, I pay $1,265, and the state of California pays the difference, regardless of what my bill is. Whether they're billing me $6,000 a month or they're billing me $20,000 a month, my share of cost is only going to be $1,265, and the state of California is going to pay the difference. And I've had cases. I had a case several years ago where we had a gentleman who had a stroke, and he was in what's called acute care. He had a trach tube, he had a feeding tube, he needed 24-hour supervision, and they were paying $24,000 a month for his care. And she came to see me, and same thing, she said, we don't qualify for Medi-Cal. We have too much money in the bank, we own a rental property. Within 2 months, I was able to get them on Medi-Cal, and actually they had a zero share of cost because they had no income. So Medi-Cal stepped in and was paying everything. So regardless of the cost. Now, if you have a married couple, I told you the state wants to make sure that that spouse at home isn't going to be poor. So if we have a married couple, the spouse in the nursing home still gets to keep their $35, but the spouse at home gets to keep $3,161 of the combined monthly income. So in the second example that I gave you, I have a married couple. Between the two of them, they get $3,300 a month in income. He gets to keep his $35. She gets to keep $3,161. And so their share of cost is only going to be $175. So they want to make sure the spouse at home is going to have enough income to survive. Now, if the spouse at home, and I've only had this happen maybe twice in my office, where the spouse at home says, $3,100 is not enough money for me. I still have a mortgage, I still have car payments, and it's very rare that we have that because most of our clients are elderly. They have no mortgages, they have no credit cards. You know, that generation, they don't do credit cards, so they have no debt. So $3,161 is usually enough. But we have had occasion where we've had couples that are younger maybe, and they still have a mortgage or car payments. And if they need more than $3,161, there is a way to do it, but we have to go to the family court. It's like they're getting divorced. We have to get a spousal support order. And we have to have a family court judge give us an order that says we need to allocate so much money of the spouse in the nursing home to the spouse at home. And if we get that court order, which is pretty easy to do, I mean, it's time consuming, but generally we don't have a hard time getting them, then we give that order to Medi-Cal, and then the spouse at home is allowed to keep whatever the amount of that order is. But now it's extending our process for Medi-Cal, because now we have to wait till we get that order before we can get the full Medi-Cal. So there are ways to get more than the $31.61. Okay, so what if I have a client, I'm going to give you a common scenario in our office, of a family that comes into our office and they say, Mom fell over the weekend, or 2 weeks ago she fell, and she broke her hip, she was rushed to the hospital, she was in the emergency room, they kept her for a few days, and now she's in rehab. She's been in rehab for a couple of weeks, and rehab called us in and they said, Mom's last day of coverage, Medicare coverage, is on Friday. And they told us we either have to take her home or we have to start paying $9,000 a month. That's very typical situation, that's what happens. Up until that point, Medicare was paying for everything. And there's so many people that are under the false belief that Medicare pays for all of this. Medicare does not pay for long-term care. It does not. So Medicare paid for the hospital, Medicare paid for rehab, and they've now done an evaluation and they've determined Mom has plateaued. Mom is no longer benefiting from rehab. So we're going to cut her off. And they usually give the family about a week's notice. That's it. They don't give them more than a week. So the family comes to me and they say, we can't take Mom home. She can't walk. She can't get out of bed. She can't get into the shower. And we work, so we can't be there 24 hours to take care of her. And we can't afford to pay $8,000 or $9,000 a month. What do we do? So I talk to them about Medi-Cal. And they say, well, we don't qualify for Medi-Cal. Mom and Dad have too much money, or they have a rental property, and we don't qualify for Medi-Cal. And so I say, okay, well, let's figure out a plan to get them eligible for Medi-Cal. Remember I talked to you about that irrevocable trust, right? That irrevocable trust does the same thing for Medi-Cal.